Scotland, Guy Johnson.
It is 30 minutes into the U.S. trading day on this Friday, January 7th. Happy Jobs Day. Here are the top headlines that we're following for you at this hour. Is it a green light for a March hike? The market looks through the stingy headline number. The unemployment rate drops and wages rise. Does this mean the Fed can start hiking in March? And you got that yield spike. How far can that go? The 5-year yield at one point topping 1.5, the highest since January of 2020. As Treasuries face the biggest weekly loss in 2.5 years. To infinity and beyond. Virgin Orbit goes public through a SPAC at the end of 2021. It's been a rocky start for the year, so we're going to sit down with founder Richard Branson and CEO Dan Hart about their satellite launching dreams. From New York, I'm Alix Steel with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, the story, the jobs number, that unemployment rate under 4%, under the neutral rate for the Fed.
Yeah, under the hood, this number looks pretty good, though. That is the real takeaway here. I think if you look at the unemployment number, it looks really strong. We got an inflation number coming up next week. That is going to be super strong. Marty Walsh is the U.S. Labor Secretary. He's with John Ferro.
Thank you, team. Secretary Walsh joining us right now from Washington, D.C. Secretary Walsh, always fantastic to catch up with you, sir. Let's just start with this labour market. Tremendously difficult to read. I look at unemployment. It looks fantastic. The payrolls number, just a little bit disappointing. Secretary Walsh, how would you characterise where we are right now in America in this labour market?
Well, I think if you look back on 2021, the president passed the American Rescue Plan. Since that time, 6.4 million jobs have been added to our economy. 84% of the people are back to work, where pre-pandemic. We dropped almost 3 points off the unemployment number in 2021, which is the lowest since the 1940s. We're seeing lots of positive signs. We know in 2022 we still are living within the pandemic, so we have work to do as we move forward. You mentioned inflation. The president is focused on bringing inflation down. The president's economic policies continue to work. We're going to continue to move forward here in 2022 to make sure we get Americans back to work and continue our strong economy and economic recovery.
Well, let's focus on where we need to do some work right now. The unemployment rate, the headline number with a 3 handle. Secretary Walsh, 2 years ago, that was unthinkable. It's fantastic to see. But the black unemployment rate actually climbed from the data that I'm looking at right now. So, Secretary Walsh, I'm trying to understand what you're doing in your department specifically to help do something about that.
Well, it's really unfortunate. Last month we had nearly a full point dropping for the black unemployment rate, and today we had an increase in the black unemployment rate. And what's even more alarming, we saw the black female unemployment rate even go higher. So we're working to make sure that we continue to create opportunities, whether it's through job training, workforce development. When the president talks about building back better, aside from the legislation, he wants to create pathways into the middle class, and communities of color, in particular the black community, is a community that he wants us to focus on. Equity has to be at the forefront of our recovery. In the bipartisan infrastructure law, as we passed, we've been talking about, as we get these dollars out into the street, these investments out into the street, we need to make sure that the black community, Latino community, also benefit from these investments and create opportunities for these jobs.
As you know, sir, another big focus for the administration and for you personally has been on vaccines and vaccine mandates. I understand the Supreme Court will hear some appeals today related to those mandates. You and I won't litigate that now, sir. I want to focus on this. How do you plan to enforce those mandates, Secretary Walsh? What's the plan?
Well, let me just say, today is a big day here, on the issue in front of the Supreme Court. Number one, the legal experts, we say that we clearly have legal authority to do it. Number two, medical experts support us as well on this. And number three, getting this passed would be a tremendous help to making sure we keep people safe, and certainly making sure people with the Omicron variant jumping up would add support, whether it's vaccines, testing, or masking. So we're going to be interested to see what happens. And quite honestly, I think with enforcement, many companies are doing this already in the United States of America. I think many companies are just going to do it. We will enforce it. We will go out and make sure that if the Supreme Court comes back and rules in the way that I hope they do today, that we will enforce it. But I don't think there's going to be an issue of enforcement. I think many companies are going to be very hopeful that this does go into existence, because they want to get people back to work and they want to keep their employees safe, quite honestly.
There is a testing option associated with this mandate, so let's talk about testing. Yep. The CDC says that if you've tested positive for COVID, 5 days passes and you no longer have symptoms, you can go back to work without a test. Secretary Walsh, is that something you support?
Well, the testing option here is that if you are somebody who does not want to get vaccinated, you'd be tested weekly. That's the option here with the emergency temporary standard that's being debated today in front of the Supreme Court. On the other rules, I mean, I know the CDC, this virus is changing, and the rules, the recommendations change often. When I say this, the virus is very unpredictable, and I think when the CDC comes down, they're following the science, and they make a ruling like that, it's based on science.
Do you think it's based on science or scarce resources? Because as you know, there's a problem finding the test. Is it based on science or scarce resources?
No, I believe it's based on science. I don't think it's about resources. You know, the president talked earlier this last month about getting more testing out to America. Companies are ramping up their ability to create more tests. Our way out of this is really going to come down to vaccines and testing. We're going to have to test more people so we can really get a good understanding of what the variant is and what the coronavirus is. You know, I've said this more than one time, but before I started this job, I was mayor of the city of Boston, and in the beginning days of the pandemic, we put a big emphasis on testing. When the vaccines came, we didn't put such a big emphasis on testing. It's important for us now to continue testing.
There are obstacles to get back to work for those individuals, even if they follow the CDC guidelines. And as you say, you believe it's shaped by the science. There are corporations that still require a negative PCR test. So I'm trying to understand from your perspective whether that's the right approach, because I can't reconcile the two. Secretary Walsh, on the one hand, the CDC and yourself say after 5 days, no symptoms, you've had COVID, you're vaccinated, you don't need a test, go back to work. The companies are stopping people from going back to work unless they have a negative PCR test. The CDC is saying don't get a PCR test after you've had a positive test from COVID. If you no longer have symptoms, you may well test positive for up to 12 weeks. Don't worry about it. You can go back to work. Secretary Walsh, we've got some work to do to help people get back to work. Are companies doing this wrong, using the PCR test to make sure people come back to work with a negative PCR?
Well, I'm not as familiar with how many companies are demanding a negative PCR test. I don't want to give the wrong answer here, so I want to do some homework on that before I give that answer. But I will say this: if companies want to make sure that their workplace is safe, and if they're requiring something above what the CDC requires, then I commend them for it to make sure that their employees are safe.
Some people are staying away from the city. They're staying away from work altogether, as you know. Mayor Adams of New York City, the new mayor, who I'm sure you've spoken to recently as well, sir, said this to us recently: you can't run New York City from home. We must have everyone participating in our financial system to allow the low-skilled and unskilled hourly employees to actually be part of our ecosystem. How important is it, Secretary Walsh, to get people back into the office? Is that something that you share, a belief that you believe in too?
Well, certainly as a mayor, you want to get people back in the office because your downtown communities, your businesses, your restaurants, your shops, your retail depend on having people in there. But I think, again, right now, where we are right now, we just need to continue to be vigilant in making sure that we're keeping people safe and creating that opportunity for telework right now as the Omicron variant is getting higher is important. I think Mayor Adams is talking about long-term as well. And certainly, that's something, if I were mayor of Boston, I'd be wanting to get people back in the office as well. I'm
sure leadership down in D.C. wants people back in the office, back in Washington too. Secretary Walsh, have you moved there yet, full-time?
No, well, I'm here. I mean, I'm here often. I don't have an apartment. I don't know why that became such a big issue. I guess I can live where I want to live when I'm down in D.C. So, I can live where I want to live. But I'm certainly in D.C. You can see the Capitol behind me today. You know why, Secretary Walsh? Because they believe that at some point you're going back up north. You're going back to Massachusetts again. You're going back to Boston. Listen, I'm going to retire in Boston. I'm going to live in Boston the rest of my life. And certainly, right now I'm here in D.C. Working for the president. The last year, I've traveled to 30 states, 60 cities all across America, getting the word out on the great work that the president's doing. We're going to continue to do that in 2022. Secretary Walsh, thank you. Marty Walsh, get in the warm. Marty Walsh, the Secretary of the Labor Department down in Washington, D.C. From New York, this is Bloomberg.
Let's get to the question of the day then. You just heard Marty Walsh talking about those strong job numbers and how COVID interplays with all of this. The U3 rate under 4%, so below the Fed's natural rate of employment. So it raises the question, is the data a green light for a March hike? Green light for a March hike. We're going to break this down over the next couple hours. Julia Coronado, Macro Policy Perspectives founder and president, and Mona Mahajan, Edward Jones, a senior investment strategist. Guys, thanks so much for joining us. Julia, Is this a green light for a March hike? Deutsche Bank says 4 hikes starting March.
Yeah, I think it is. I think what we're seeing is whether, despite the discrepancies between the household and payroll hiring numbers, all of the signals are that the labor market is tightening and is tight. Whether it be the wage gains, the unemployment rate, all of the measures of underemployment, including people working part-time involuntarily and other dimensions of underemployment that were such an important source of downward pressure on wages last cycle, they're tightening very quickly. So this is a workers' job market. There's more demand than supply. A lot of that, per the prior discussion, is still tied to COVID, but those frictions aren't going away. And so the Fed needs to calibrate to the current economy and at least get going on rate hikes. I think a March rate hike is definitely a go.
Mona, what's your view on that? And if the Fed is in a hurry, how different does my portfolio look in 2022 than it did in 2021?
Yeah, absolutely. Look, this job market was once again indicative, as Julia mentioned, of a tight labor market. It's really a supply issue still. Where are the labor supply? Where is the labor supply in the U.S.? We're still about 3.6 million jobs short of where we were back in February of 2020. So, increasing demand, short supply. This is a Fed that's still going to be worried about labor force participation rates, about being broad and inclusive in the labor market recovery, really about what's going to be the impact of the Omicron variant and the virus uncertainty going forward. So I'm not quite sure if it's a complete all clear here. Tightening rates and tightening policy aggressively at this point may not address some of the issues we're seeing on the supply side, certainly on the supply chain side. So it's something to keep in mind as we go forward. We do think as a team, the Fed still has room to be patient, to be deliberate, especially as we head to the second half of this year. From a portfolio and market perspective, we continue to favor those value cyclical parts of the market, especially in the first half of the year. We're certainly seeing that play out in week one already. But as we move forward and as growth moderates, investors will be looking towards sources of growth and maybe a little bit more defensive in quality. So tech, areas like staples, healthcare, all become part of a balanced portfolio in 2022.
So, Mona, to that point, first of all, I'm glad we all got the color-coordinated memo, guys. That feels like a big win for us right now. But Mona, so on that, do you buy the dip in tech then in sort of to set yourself up for that kind of shift in the back half of next year?
Yeah, we think the risk reward is getting more and more interesting, especially if we get a few more days of this sell-off. Look, historically, since the pandemic, we've gotten about 3 times where we've seen this movie play out. Rates move higher, parts of tech move lower. In fact, on average, it lasts about 21 days or 3 weeks, and the NASDAQ sells off from its recent peak about 7 to 8%. So the NASDAQ is off about 5% now. If we get a little bit more downside from here, we do think the risk reward becomes interesting, especially for longer term investors and for those investors who really haven't built the exposure to this area that they'd like to. It's come much earlier than we anticipated, but we do think kind of taking advantage of these opportunities and periods of volatility is certainly what we've been calling for in 2022.
Julia, to that patient point that Mona raises, what do you think next month's number looks like? Omicron would have had some impact in this data. What about the next set of data?
Yeah, and let me start by saying I agree with Mona that the Fed does have scope to be sort of methodical, but the stronger the data are, the more it needs to get going on that methodical approach to policy normalization, and hence the March rate hike. But what do the numbers look like in January? Well, we are already seeing the moderation in hiring in leisure and hospitality. That is not just a function of Omicron, but just a function of the ongoing pandemic in general and a leisure and hospitality sector that may remain below its prior level of employment. People just aren't going to go out to the extent that they did before, and Omicron only reinforces that. And I think the broader point of what we're seeing in this slowing in hiring is that the sectors that are most impacted by COVID, healthcare, state and local governments, leisure and hospitality, this is where the hiring has slowed the most, is likely to continue to remain pretty sluggish, especially taking into account Omicron. So I don't think that we should expect to see hiring numbers in the neighborhood that we saw last year. And we're going to have to get used to, a slower pace of hiring in 2022. We're just going to see slower numbers, and those sectors impacted by COVID are going to struggle to find the workers they need and want.
So how does that forecast then for the labor force participation rate? Because as John and Marty Walsh were just talking about, minority unemployment didn't really move the needle. Women didn't come back into the workforce to the same extent, Julia.
Yeah, I think this is a process that's going to take time. There are real frictions for people. How many schools and daycares right now are having to shut down because of outbreaks? And that puts parents in a difficult position to navigate that. So yes, that's a friction that's going to hold people back for longer. And sorry, my cat.
No, we love it. We love it. She has something to say.
Will not shut up.
She wants in.
So yeah, I mean, those frictions, and I think we saw that in the minutes from the December FOMC meeting, that now there is an acknowledgement on the committee that this process of healing in the labor market and labor force participation, we still expect it to happen. They still expect it to happen, but it's going to take some time.
Mona, where does this all leave the consumer? We're going to get a CPI number next week, Wednesday. 7.1% is the headline number. Hourly earnings coming in much below that. Are we going to see a consumer squeeze this year? And what is going to be the impact of that?
Yeah, look, we're still seeing a consumer that's actually quite healthy, and that's thanks to not only some of the PPP and stimulus programs we got earlier in this year, it's also due to an elevated savings rate. People are at home more. They're not spending to the extent that they were prior to the pandemic. And so that really puts us in a position heading into 2022 with a consumer with a very healthy and strong balance sheet. The question will be, some of the demand that's pent up as the supply chain issues kind of, unfold. Will that demand still be there as we start seeing easing in supply chains, labor markets easing as well? If that is the case, we think this could be an interesting year. We still expect economic growth, which, keep in mind, GDP growth is 70% driven by consumption. We still expect above trend economic growth in the 4% range. We still expect earnings growth to be 7 to 10%. Consumer and corporate balance sheets remain healthy. And so really what we're looking at here is an economy that perhaps is somewhat delayed, but not entirely derailed by both the virus uncertainty and the supply chain uncertainty.
All right, quick question, like 20 seconds for each of you. This year, curve, steeper or flatter? Let's start with you, Mona.
We expect the curve to actually steepen. We've already gotten a bit of it this week, but we expect some steepening as the 10-year heads to 2% and as those Fed expectations are flattened.
Julia?
I think it's a more open question with front loading of Fed rate hikes. And yet a lot of indications that trend growth isn't necessarily higher than it was before. What we can see is just an earlier path of normalization, which could mean a flatter curve, even though the whole suite of rates goes higher.
Okay, so a bear flattening. Uncertainty is the word I would take out of all of that. A lot of it seems to be around at the moment. The path forward looks a little hard to read right now. Julia Coronado, Macro Policy Perspectives founder and president, and the cat. Thank you very much indeed. Mona Maharajan, Edward Jones, senior investment strategist. Thank you very much indeed as well. What are we going to talk about next? Cathie Wood's ETF getting battered. Tech turmoil certainly hitting every single US ETF led by Cathie Wood. There's one ETF that's gaining on ARC's pain. We're going to talk about that story next. This is Bloomberg. So it's Payrolls Friday, but it's also ETF Friday. We're looking at how Cathie Wood's funds are hurting from this huge tech sell-off we've seen since the start of the year. Let's dig into the details with Bloomberg's Katie Greifeld.
Well, Guy, we know that last year was rough for Cathie Wood. So far, 2022 doesn't look much better. If we look at her biggest fund, the ARK Innovation ETF, it's down over 7% so far, just in the first 5 trading days of this year. If you look at the other side of the trade, the Total Capital Short Innovation ETF, that tracks the inverse performance of ARK-K. You can see it's higher by, it's up over 9.5%. That ARK Innovation ETF down by over 9%. And it's really interesting what this means for the flow show. You can see that the investors who really poured billions of dollars into that ARK-K fund in 2021, they hung tough for a while, but now you're starting to see some outflows. 6 of the last 7 months have seen investors actually pull cash from ARK-K, and the fund is on track for a second straight week of outflows so far this week. And that cash is finally starting to come out as you see the ETF start to hit its lowest levels since about September 2022, which really comes as no surprise if you look at some of its top holdings. As you can see, it's really a lot of tech names, and Roku in particular, that is the 3rd biggest holding in the fund. It's down about 19% just this week alone.
Yeah, it's been a pretty brutal week. All right, Katie, thanks a lot. Bloomberg's Katie Greifeld joining us there. And this sort of dovetails with the market action today. The NASDAQ now down by 0.3%. Terrible start to the year. Yields pushing higher here. The 5-year at one point breaking 1.5, which leads us to the question of the day. In the payrolls data, is it a green light for a March hike? Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence, joins us now. Is it?
It is. The data was good enough that there's no reason to think that the Fed's going to wait to hike at this point. We had been thinking they were going to hike probably in May, kind of give it one meeting after they were done with asset purchases before they hiked. But at this point, it seems like they're pretty keen on hiking, and this data certainly helps their case.
Mike, Ira. I thought I was going to be talking to Mike, but I'm talking to you. I need to get that straight. It's been one of those kind of days. I apologize.
It is that day.
Your patience has also been amazing. Ira, talk to me about the sequence here. How is this actually going to work? The Fed is basically compressing a lot of stuff into a very short period of time, potentially here. We're going to have taper, we're going to have hikes, and we potentially could have QT. Just talk me through the timeline of how this is now going to work in your mind.
Yeah, so the way that we're thinking about this at this point is the minutes on Wednesday made it pretty clear that the Federal Reserve is worried about flattening the yield curve too much. And the only way that they can avoid significant flattening of the yield curve this year is by not hiking as much as the market currently has priced. Maybe they'll hike more over a longer period of time as opposed to hiking a lot very early. And they explicitly said that they might use balance sheet policy as a way of avoiding a significant flattening of the curve. So what does that mean? Well, that means maybe they go 3 times this year. We're thinking maybe March, June, and then probably December at that point. But then start in July with their runoff of their portfolio. So basically letting their mortgage-backed securities and Treasury securities mature, and then the Treasury Department has to sell more bonds on the other side, and that should keep the curve from flattening too much over the course of 2022. It will flatten probably. One way or the other. The Fed is going to be in hiking mode, but it will flatten maybe a little bit less severe than the market's currently pricing.
Okay, so what is the path of least resistance for yields then on that forecast? Let's go with the 5-year because the belly's underperforming, and then also real yields.
Yeah, so I think the belly is likely to underperform over the next couple of months, but ultimately, you mentioned that it hit 1.5% today, which obviously the 10-year was only there at the beginning of the year. But I think that the bear flattening case is pretty strong this year. That is our what we think will be the major theme for the market is just generalized bear flattening. We think the 10-year will reach right around 2% by year end. I mean, it could reach there in a couple of days. Just given the strength of some of these moves, but people have reset short. So one of the reasons why you saw that big move the first couple of days of the year was people had basically gotten out of short positions in December. They reset those at the beginning of this year. So I think that the market is a little bit better prepared for higher rates now than it was on December 31st.
It's going to be an interesting year, isn't it? There's a lot to squeeze in. Ira, thank you very much indeed. Always a pleasure. Ira Jersey of Bloomberg Intelligence. What's next? We're going to talk about Virgin Orbit. The stock is up today, but it's had a really rocky start. This is a SPAC that we're talking about here. The company has gone to this SPAC recently. Richard Branson is going to be joining us. Dan Hart, the CEO, is going to be joining us. That's next. This is Bloomberg.
are 1 hour into the U.S. trading session. Such an interesting week. After that jobs number 2, yields higher, tech lower, but it feels very different than what we saw earlier in the week. Abigail Doodle is looking at all the moves here with us. NASDAQ 100 now, I'm looking at down 1/6%.
Yeah, you know, Alex, another whippy day and a whippy week. The start to this new year, lots of chop and volatility. So the S&P 500, the NASDAQ 100 earlier higher. Now we have that NASDAQ, to Alex's point, down about 0.6%. Right now on pace, the last time I looked, for its worst week since October. At one point, though, yesterday it was on pace for its worst week since February, depending on the level of the decline. Interesting, though, is the fact that the China tech index is higher, up 2.3%. This despite the fact that yields are higher. It seems like a little bit of a bounce back or catch up for a badly beaten down sector. Of course, last year, this index falling more than 4%. Now, the source of pain for tech this week is clearly this 10-year yield. Backing up over the last 5 days. This is extraordinary. Backing up 25 basis points or 0.25%, 177, basically the highest level since January of 2021. And of course, this brings into question valuation on tech stocks. It also helped out the banks and the energy. So this week we have this huge divergence between, my gosh, Wells Fargo up 14% on the week. I believe that's its best week since June of 2020. That's the kind of buying power. Of course, it's one of those big money center banks. So when yields go higher, it really helps out their lending activities. Exxon Mobil up 12% this week. That's extraordinary. This is not a year, not a month, not a quarter, in 1 week. Of course, being helped out by oil, but the cyclical value reflation trade, it is in full force. On the other hand, Apple down 2.9% this week, off of its lows, but nonetheless not a great way to start the new year. And Nvidia down even more, down 6.2%. Now, one reason to think that more volatility could be had, I love this term. Chris Murphy of Susquehanna joined us on Options Insight yesterday, and he's making the point he doesn't think that the tech selling is over. The reason being there's not enough stress showing in the market. So one way to look at it, on bottom here is the 10-year yield. So back in March of 2021, when the 10-year yield was around current levels, that's when we had a pretty big sell-off for the NASDAQ 100 in particular. That showed with the VIX-in, which is the NASDAQ 100 VIX relative to the VIX, spiking super high. So telling you that the tech index, that there was a lot of stress there. Right now, we're not anywhere near that level, Alex and Guy, suggesting, again, there could be some more pain ahead for tech traders.
Abigail, great stuff. Thank you very much indeed. That is a fantastic final chart, by the way.
Hey.
I think Alex was going to use it a little bit later on in our battle, not battle of the charts. So
that's right.
Yeah,
and I'm
now
frantically now looking for a substitute.
Yeah.
So we'll see what happens.
Something that involves backwardation, maybe. That's commodities. Maybe go down that road. Why not?
Go. I'm busy now.
Okay, so Alex has got work to do. So I'm looking at a shot. I've got bars on my screen right now. We're waiting for the president. He's going to be speaking theoretically at around 45 minutes past the hour. We'll see what happens in terms of when the president arrives. But we are going to hear from him talking about what happened today with the payroll number, what that means for the economy that he manages. We heard from Marty Walsh a little bit earlier on. We may also potentially get some news in terms of the Fed picks as well. What are we going to hear? Well, let's go to D.C. right now. Anne-Marie Hordern, Bloomberg's Washington correspondent, standing by. She's at the White House. Anne-Marie, over to you. What are we going to hear from the president?
Well, the president is likely going to talk about the fact that even though the payrolls number was a miss, there's two big components of it that were positive. First would be the revisions for October and November, and then that unemployment rate dropping to 3.9%. We are just a smidge off of where we were pre-pandemic, of the 3.5% level. That is something the president is likely going to focus on, the fact that there is a recovery. And then he'll probably try to take a moment to push through his economic reforms and the challenges he's having within his own party to get Build Back Better through. One of them is the child tax credit. And if you look at what's happening with women and the participation rate, much of the participation rate for women still remains low, very much so. Women are on the sidelines of this economic recovery. But the past 4 months, we have seen women coming back into the workforce. Potentially that could be, and I'm sure the president would like to make this argument, because it's extended child tax credits. This can be an avenue for him to try to pivot of what more needs to be done in terms of his economic legislation.
Anne-Marie, we will look forward to that as it happens. We will bring you the president live when he speaks in a few minutes' time. As I say, I'm looking at color bars, the shot coming out of D.C. right now. We are expecting the president to speak in around 10 minutes' time. We'll see exactly what the timing looks like. Let's completely change gear. Let's talk about something completely different. Virgin Orbit, its stock is up today, but it's been battered since it started trading on the NASDAQ a few days back. It's the world's first responsive air launch system. Basically, it's sending smaller satellites into low Earth orbit. This is technology they're using. It involves the 747. They fly the 747 pretty high. They launch this thing up into the atmosphere. It's a different tactic, obviously, to the one that's being used by SpaceX and others. Here to talk about this and where the space business is going next, Sir Richard Branson, Virgin Orbit founder, and Dan Hart, the company's CEO. Gentlemen, Happy New Year. Welcome. Thank you very much indeed for your time. We're looking forward to talking about all of this. So, Richard, if I may start with you. We'll talk about Virgin Orbit in just a moment, but I want to get an update on how you're feeling. I understand you've been hit with Omicron over the last few days. How are you feeling? How are you coping with it? And does this change your attitude towards testing when it comes to travel?
I'm feeling great. We've had about 30 family members and friends get Omicron over the last few weeks. Fortunately, none of them have had it worse than than a common cold. And some of them, my wife didn't even realize that she had it. So I think the positive thing is that we were all we all were vaccinated and we were all boosted. And I think that as long as people can get vaccinated and boosted, it's likely that for the vast majority, you're hardly going to know you've had it.
Richard, just one quick follow on that. It's Alex here in New York. As Guy was mentioning, does it change how you feel about testing to go on vacation and go on airlines? It is quite confusing to figure out what's what.
Well, I think the British government, the German government have just basically made very good moves, and that is to say the testing is now no longer needed, and that Omicron is a fact of life, and that people should be able to get up and travel again. So people should be able to go on holiday. People should be able to go on business again without the big expense of testing. And I hopefully other countries that are still left to remove that will do it, because I think the facts are that this is just something we're going to have to learn to live with. We've had it for 30 months. We just got to get people vaccinated. We've got to get people boosted, and then we just got to get on with things.
Dan, let me turn to you and let's talk a little bit about Virgin Orbit. It was a really tough year last year for space-related stocks. You've come to market, you've done this SPAC. The stock has taken a little bit of a hit. I think over the last 10 days, I just checked the numbers, we're down by around a quarter in terms of the value. What is it going to take to get space into people's minds, into investors' hearts, to convince them that this is a place that they want to allocate money to? We've seen, obviously, huge amounts of money pouring into the EV sector, other high technology areas. What does space need to do? What does this business need to do? What does Virgin Orbit need to do to convince investors that this is the place to invest in?
Well, so number one, 2021 was an incredibly exciting and successful year for the company. We proved our technology. We went into commercial operations. We put 19 satellites into orbit, from paying customers from NASA to the international community, the commercial community, and the national security community. So for our company, we pierced the pandemic and drove a new technology into space launch. And what will we have to do? We got to continue to do that. In the last 8 weeks, we penetrated the market more than we ever have. We signed a deal with ANA Airlines for 20 launches out of Japan. We signed agreements with new space technology companies like Hypersat for hyperspectral imaging of the Earth, ARCIT, quantum encryption from space, Spire, Boeing, other companies. It's frankly a very exciting time for us. And what we need to do is continue to do that, and that's what we plan to do. We have a rocket that's in Mojave right now being ready for launch over the next few days. We'll launch that. We have launches coming behind it. We have the first launch out of the UK coming this year. Our system is unique in that we can launch from pretty much any airport that can handle a 747 across the world.
I suggest that Guy go on location for that. We will be circling back with you guys for the UK launch. Dan, there are different aspects to space. One is going to be deeper space exploration like Mars, one's the moon, one's space travel, and one is low Earth orbit. And that's satellites that are closer to Earth. And that's really where the fundamental money-making ability is going to be. How big is that addressable market, Dan?
Oh, the market for space, is growing. Overall, space is growing to be well over $1 trillion market from about 400 million right now over the next 15 to 20 years. So the forecasts are very strong. Low Earth orbit, small satellites is the strongest part of that growth. And our system is geared towards making sure they can get to the right orbit at any time to maintain the connectivity to their customers, or from the national security point of view, to do critical missions.
Dan, is there a plan to evolve the business model beyond launching the rockets, the satellites from below a 747? Is there a different model that you could ultimately end up pursuing here? And as an extension to that question, if not, do you see yourself in a different market, for instance, to SpaceX?
So we have reached into very unique markets. I mean, for instance, I mentioned the UK. We can set up shop and give countries the capability to launch from their sovereign shores without them doing much except use an existing airport. There are environmental benefits to it that ground launch doesn't have, as well as flexibility and affordability. So, I mean, there are almost 80 space agencies across the world right now. Only about 10 countries have space launch. That's a huge business opportunity. Additionally, in national security, which is becoming more and more important, I mean, you've read about the Russian anti-satellite test, for instance. We can be available in case a satellite is threatened or damaged and put them up in a moment's notice. And hopefully that incentivizes aggression in space.
Dan, it feels like every company out there is trying to get involved in space to some capacity. Recent Chinese complaint to the UN about a SpaceX Starlink, a near miss with their space station. How crowded is it getting up there, and does that limit the addressable market for you?
What's needed in space, really, and I think everybody is in agreement on this, is more international collaboration and cooperation and infrastructure so that we can do space traffic management just like we do air traffic management today. We have the technology, but we haven't made the investment as an international community yet. So the UN, working with the main space providers, really need to provide that. Once they do, I mean, think about the number of aircraft that fly every single day. Space is much bigger. If we can control it and coordinate it in a similar way, there's a huge amount of upside to space. It's pretty much boundless.
Things move pretty fast up there. So, Richard, the SPAC that you're celebrating today is one of a number potentially that you could be involved with. There's been some reporting in the UK over the last few days that you are looking to sponsor a SPAC, let's call it circa 200 million, that could be launched on the Amsterdam market, potentially in Q1. Is that something that we can confirm? Is that something that you're talking about? Can you give us an idea of what your plans are around that?
Not talking about it today. I love Amsterdam. I've lived in a houseboat for a lot of my life. So, maybe I need a new houseboat. So maybe you'll see me in Amsterdam sometime soon.
Okay, let's turn to another potential IPO. Shai's done a great job strengthening and stabilizing Virgin Atlantic. You recently injected some money. Delta also injected some money into the business as well. Does that mean that an IPO is not happening for VA, or are you still considering that as an option?
I personally haven't actually considered it. The team have explored lots of different ways of keeping Virgin Atlantic going and strong over the last 30 months. And I have enormous respect for what Shai and the team have done. They're coming out on the other side now, I think, with the new moves by the British government and getting rid of testing. That's going to mean a lot more people traveling. I think hopefully we can start looking into the rear mirror when it comes to COVID. So, so they've got the money to do the job without IPOing. Who's to know what might happen in a year or two or three's time?
You would know. All right, Richard, thank you very much. Richard Branson, founder of Virgin Orbit, and Dan Hard, CEO of Virgin Orbit as well. Guys, really appreciate it. Thank you so very much. Okay, we are awaiting President Biden's remarks in the December jobs report. In the meantime, quick check-in here on the markets. NASDAQ 100 rolling over by a full percentage point now around the lows of the session. You also the 10-year yield now rising to 1.778, the highest since January of 2020. The belly still underperforming, though. The market's definitely on the move. Higher yields, weaker tech. That's the story. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, former New York Fed President and Bloomberg opinion columnist Bill Dudley joining Bloomberg TV. That's at 3:30 p.m. in New York. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. It was the weakest U.S. jobs report of the year. Employers added just 199,000 jobs in December. That's less than half of what the median estimate was in a Bloomberg survey. But the employment rate fell more than expected to 3.9%. And average hourly earnings surprised economists, rising 4.7% for the year. So all of that suggests a shortage of workers may be holding back the hiring. In Kazakhstan, the president has ordered security forces to shoot protesters without warning. He's declaring victory and putting down demonstrations with the help of Russian troops. Dozens of people have already been killed and hundreds wounded. It's the most serious challenge to Kazakhstan's leadership since independence back in 1991. And Citigroup was the first major Wall Street bank to impose a strict coronavirus vaccine mandate. Now it's telling office workers that those who don't comply by January the 14th will face termination. Bloomberg saw a message to staff that said their last day of employment would be the end of the month. More than 90% of Citi employees have complied with the vaccine rules for U.S. workers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy, Alex.
Ritika, thank you very much indeed. So Alex, increasingly feels like if the carrot doesn't work, we're going to use the stick.
Yes, and you have to wonder if the stick is going to wind up having to go to court. We know the Supreme Court is looking at the President Biden's vaccine mandate. The arguments start today. Is this sort of the result of something that we might see in the private sector as well? Also, what does this wind up doing to the job market? I mean, I understand that 90% of the workforce is vaccinated, but still, we have a labor shortage in some respects, and then you have to wind up firing and then rehiring. How's that going to work?
Well, I think it's going to be really difficult, particularly for those areas. You think about a frontline retail job, you think about a frontline job anywhere where people are nervous, worried, they don't want to wear a mask all day. Now they're being told that they basically have to get the shot as well. It's going to mean that those jobs, I think, are going to be harder and harder to fill.
Yeah, I should point out, I just want to switch gears for a second. Mary Daly is talking right now. Some interesting things are coming out. She's saying that the Fed could adjust their balance sheet after 1 or 2 rate increases. And that goes to your point earlier that there could be a scenario where we're going to see a lot of tightening happening kind of in a small window. And that might support that. We are in a time where we need to adjust policy, she says.
Yeah, and that raises the prospect of a policy mistake, doesn't it? The Fed has basically been wait, hurry up. And now we're in the hurry up phase, and that's where kind of things can get broken. So I think it's going to potentially get really tricky for the Fed. They've left themselves in this position. Now they've got to deal with it. Yep,
and she also said that she prefers a flatter funds rate path, more balance sheet adjustment. That was another question this week. Which tool will they use more of? Rate hikes or the balance sheet adjustment? All right, coming up, we are still awaiting President Biden and his remarks in the December jobs report. Market rolling over, NASDAQ 100 off over 1%. This is Bloomberg. from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. Every Friday that Guy and I are here, we pick one of our favorite charts of the week. So here's mine, and it has to do with technology. I also crashed this in the last 10 minutes, so bear with me on this one. So the S&P 500 is the purple line here. These are the other areas of tech. For example, the yellow is hedge funds, crowded stocks. Then the blue is profitless tech. And then the white is expensive software. Morgan Stanley looked at other times where we've seen a tech sell-off in relation to higher yields and found that we're kind of near the bottom of where we traditionally are when it comes to tech. They do say, though, with the S&P is that we're nowhere near where we usually get and that you could see the S&P come under more pressure as rates, especially that front end, continue to rise, Guy.
That was a nice chart, and as you said, crashed very nicely together to make it happen. This is a chart that I think is kind of at the roots of what I think is going to be a major problem for Europe. And it speaks to the inflation that we are going to get. We had very strong inflation data out of Europe today, but the green transition is going to happen, and how inflationary it is going to be absolutely critical for Europe going forward. So I want to take you to China. I want to talk about lithium, the lightest of metals, and what is happening here. Basically, as China tries to migrate towards EVs, it is pushing up battery prices, it is pushing up lithium prices, in fact, to records. The move has been absolutely eye-watering, and it is going to be replicated elsewhere. As battery technology picks up, lithium is going to be absolutely critical, and how much it costs will determine how quickly we can make this EV transition and how much that EV transition, Alex, is going to cost and how inflationary it is going to be. We saw record inflation out of the Eurozone today. Is that number going to continue to creep higher? Gas looks like it's going to be the swing factor this year. The question is, will lithium and other metals like it be the swing factor going forward from there as prices continue to rise? We're going to talk about this in the next hour. The European close is coming up. As I say, Eurozone inflation skyrocketing. Hugh Gimber, JP Morgan Asset Management Global Market Strategist, joining us to talk about that. The close is next. This is Bloomberg.